Hello, welcome to Wacker Chemie's full year 2021 results. My name is Joerg Hoffmann. I will lead you through the presentation that my executive board, the CEO and CFO, just gave to investors, and we'll walk you through the presentation. As always, if you have questions following this presentation, you'll find my contact details at the far end of the presentation, and I'm happy to chat with you. So let's get started. Well, message from the lawyers, you're familiar with this, risks and uncertainties and so forth. But let's look at 2021. It's been a fabulous year, incredible performance. We surpassed sales beyond 6 billion euros. Actually, sales increased over 30% year over year. We more than doubled our EBITDA and had a fantastic cash flow performance. Net cash flow came out at 761 million euros, and this is after we contributed 250 million euros into the unfunded portion of our pension funds. Earnings per share were over 16 euros, and that results, per our logic, 50% payout of net income in a dividend proposal of 8 euros. We'll look at that in a moment to give you some context. But where does this all come from? It comes from very strong demand in our chemicals. We're experiencing a massive demand pull for our products, especially in silicones, but also in the polymers division. So this is in polymers construction, packaging materials, paints and so forth. In silicones, it is across the board, typically advanced specialty products where we have close relationships with our customers, and we were providing tailored solutions to our customers. Polysilicon through last year stayed tight. To a degree, to our surprise, we had to increase our guidance in many steps last year because we had always expected some weakness in polypricing, which never occurred, and our volumes are totally sold out. Sustainability, a very important topic. We had a CMD at the end of this, in the middle of December last year, where we talked about new ambitious goals for carbon and emissions reductions. We have now put targets out for 2030. We are participating in the TCFD initiative and in other initiatives. This path to net zero is certified. So you'll hear more about this. This is part of our business, and it makes good business sense to do this. So let's move on. Here you see our historical dividend payments. We have always made sure that we have shareholders participating in the success of the company. This is just how we see ourselves. So in 2017, this resulted into a bonus dividend. And since then, we have even paid our dividends when we had negative results, such as in 2019, when we suffered an impairment on a recently built plant in the US. And as our profitability increases and changes, so does our dividend grow and breathe with our earnings. So if you're a shareholder, congratulations. If you're not a shareholder, have a close look at this. As I said, we are committed to paying dividends to our shareholders, but we're also committed to sustainability. Now, there are three major levers or homework dues that we are, and chores that we have to do to get to our targets. And this really takes care of the bulk of our CO2 emissions profile. The first and the biggest thing is producing CO2 neutral silicon metal. We have a silicon metal smelter in Norway where the process by design produces CO2. Now we're going to look to replace coal with charcoal and biocarbon biomass, and that results in essentially silicon-free, CO2-free silicon metal. It's essentially something that our customers are already asking for, so you can rest assured we are making good progress on this. In addition, we're looking at process transformation. We're stopping to look at CO2 as an emission, but rather looking at it as a raw material. We've designed some innovative processes, and we're now trying to tap into some of the innovation support funds that the EU provides, essentially converting CO2 to methanol. You may know that methanol is a key material that we use in our silicones production. And again, customers have already started asking when they get the material, but the plant needs to be built. And because it's expensive, and obviously at this point in time, not competitive at all, it needs some support, and it should get it. The next step is that about 80% of our CO2 backpack is essentially from the grid. So as the grid becomes greener, and as we find ways through PPAs and other things to acquire green energy that will have a significant impact on our CO2 profile. So watch this space. But now let's move on, go into what we see for 2022. Guidance in our business is difficult, but doable, and at the same time also quite exciting. For 2022, we now expect to grow sales to over 7 billion euros, with an EBITDA between 1.2 and 1.5 billion euros. CapEx more than doubles to about 550, maybe 600 million euros. Most of that goes into a diverse set of projects that push our specialty capacities forward and are essentially answering a desperate demand pull from our customers who are asking us for more and more volumes. Q1 is expected to come in rather strong, with increased prices in silicones responding to massive inflation in raw materials immediately. And there are trailing effects from cost of goods sold that with an operating cycle of 1 to 2 months, that essentially means we have current pricing matched with historic costs. So Q1 should see a significant benefit from our price increases. That kind of goes away and reverses in the other quarters. Well, we've never really guided with a war on our doorstep. So there are other complications, but at the same time, this is a convincing and confident outlook. And you should take it as that. So let's have a look at the P&L. What you can see here quickly is that the gross profit increased massively. Sales increased by 32%. Prices contributed here to 20% growth. But at the same time, volume and mix also contributed by 12%. This is a feature that you will see time and again at Wacker. There's very strong organic growth in our businesses. So we digested in our cost of goods sold over 500 million euros of unprecedented rises in raw materials and energies. Siltronic came back into the fold after the transaction with Siltronic failed. It didn't get the approvals from the German government. We consolidated back as at equity. Previously, it was held as net sale. So our share in Siltronic's net income will now show up minus PPA effects in the others segment line. So let's move on. Balance sheet, extremely strong. Our pension liabilities decreased by 900, that's 900 million euros last year alone. Compound effect of slightly higher discount rates and cash contributions to the pension fund overall. The full pension liability now is down to about 1.5 billion euros if you take into account the deferred tax asset related to pensions. Now let's move on into the various segments. Let's begin with our largest segment, silicones. Fantastic material, the chameleon of plastics, a myriad of applications, and essentially one of the most capable plastics out there at all. Actually, one of the most performing materials out there, because you can combine all kinds of different properties here. So it's a rather exciting material. Sales grew to close to 2.6 billion euros. We just barely missed the 2.6 billion level. And profits, EBITDA, increased by 43% last year. CapEx up to 140 million. As you see, we are stepping up our efforts to meet the demand from our customers. We faced a very broad-based demand with order intake at extremely high levels throughout the year, and that really hasn't abated. At the end of the year, we were seeing significant price increases for silicon metal, a key material that we use, and also for energy. And we immediately reacted and increased our prices. This is going to benefit us in Q1. So we acquired a specialty silicones manufacturer in China. In the course of last year, we expect the closing of this in the second quarter of this year. Polymers, our second largest business, increased sales by a full 30% in the wake of raw material escalation that started early last year. We covered those with surcharges, and so we basically defined surcharge levels, so levels from which onwards we would have add-ons to our pricing. Basically, the idea was to lock in our absolute earnings. We were largely successful with that. So earnings declined only by 7%, despite raw materials being really off the charts. And essentially, this was our way of sharing the burden with our customers. We still have a little bit of profitability left to recover, and we will go after that this year. But you also see here that CapEx nearly tripled last year because of the strong demand that we're facing. And this is a recurring theme across the board at Wacker. Biosolutions, we continue to make progress in our biopharma bioingredients business. We've developed new partnerships. We are now essentially a full portfolio provider for mRNA solutions. And there's a lot of other things upcoming that you will see unfolding over the next quarters. EBITDA was supported by higher utilization, but we are also facing ramp costs and costs of growth across the business as we acquired a pDNA business in the US. Polysilicon was largely responsible for the series of improvements in our earnings outlook in the course of last year, as prices just did not budge and continued to move up in the course of the year. So sales nearly doubled and profitability went back to over 600 million euros or an EBITDA margin of 40%. This is interesting to note because at similar average prices, just 2 years before, we had a significantly lower EBITDA contribution. So we can basically directly see the results of our ambitious efforts to reduce costs across the board in this particular business. CapEx, as always, rather restrained because we focus on materials mix and not on volume growth in this business. Now, let's move on to the cash position. So we've moved in this period from the end of 2020 into the end of 2021 from a net debt position into a net financial asset position, and quite substantial. You see here we paid out a dividend of 100 million euros, and the net asset position was 550 million euros at the end of last year. Here's our guidance in all the glory detail for 2022. I think the important things are here that we expect net income to be a little bit lower, depreciation stays where it is, and that we see a ROCE substantially higher than the cost of capital. We're always calculating with 10% cost of capital, maybe a bit high, but this is a theme that is valid for the entire business. We're earning significantly more than our cost of capital. And that's the economic explanation of value creation. So there you go. Now, Q1 trading update, don't want to bore you on this slide because we've covered it all. And that kind of ends my presentation today. So what have you seen? You have seen a very strong performance in 2021 across the board in all our businesses. In all our businesses, we suffered from allocation and product shortages and so forth. We just couldn't make enough to service all our customers' needs. We will deploy capital to remedy the situation. We will deploy capital to better serve our customers, to provide them with the volumes that they need, with the right levels of profitability in the right regions and at the right time. We have a whole portfolio of projects that we're looking at, so there is no cluster risks involved in this. And you're going to see a broad-based approach to growth in this business. So there is more to come. This year, despite the tragic news that we have not far from our borders, is developing well. The first quarter looks really outstanding. There are risks in the rest of the year, but we will counter those. We have everything that it needs. We have a very strong business, and you should watch the space. There's more coming. So we have a capital market day upcoming at the end of March. We will publish all the relevant materials for this on our webpage. And again, thank you very much for bearing with me through this presentation. I hope you found it interesting. There's a lot to discover at Wacker. You will enjoy this. So let's join me for the ride, and I'm looking forward to speaking to you. Bye-bye.
Since you watched this company video until the end, I'm guessing you liked the video. That's probably because we work very hard to create the most engaging and value-added content possible for you. If you're a stock listed company or corporation and want to find out how we at C11A can make a company video with and about you, please email us at community@c11a.com.